Silver just broke $88. And right now, inside China, recyclers are paying $96 per ounce for scrap. Not coins, not bars, scrap. Used silver, recycled industrial waste melted back down into raw metal. And if you understand why that number is $96 right now, you will understand why $100 silver is no longer a question of if, it is a question of when. Because right now, 4 separate forces are colliding simultaneously in the silver market, and every single one of them is pointing in the exact same direction. I'm going to break all 4 down, and by the time I'm done, you are going to see something the mainstream financial press is not connecting for you. Something that changes the entire picture. Let me start with the number that stopped me cold when I first saw it. China's largest silver recycler is paying $96 per ounce for scrap silver right now. Not investment grade bars, not freshly minted coins. Used silver, recycled silver. Industrial waste from old electronics and manufacturing floors melted back down into raw metal. When I first saw that number, I thought it was a mistake. I checked it again. Then I checked a third time, and that is when it clicked. The international paper price right now is $88 per ounce, which means inside China, recyclers are paying $8 per ounce above global spot just to get their hands on garbage silver. Think about what that tells you. When a recycler pays more for scrap than you can buy brand new silver for on the open market, it means the physical shortage inside China has become so severe that they will pay any premium just to keep their production lines running. And here's the part that nobody on financial television is connecting right now. This is where it gets dangerous. China controls 60 to 70% of global refined silver exports. And as of January 1st of this year, they implemented a full export licensing framework. Only 44 state-approved companies can now export silver. You need annual refining capacity of at least 80 tons and a credit line above $30 million just to qualify. That wiped out hundreds of smaller exporters overnight. In a single regulatory move, China just locked the door on the majority of the world's refined silver supply. And they kept the key. So China's recyclers are paying $96 for scrap. And the metal they produce is staying inside China. It is not flowing to London. It is not flowing to New York. It is nowhere near COMEX. That supply is structurally gone from the global pool. Not temporarily, not until next quarter. Gone. Now watch what happens when you put that against what is draining out of COMEX right now. Because this is the part nobody is pricing in yet. COMEX registered inventory is the physical silver sitting in exchange-approved vaults that backs every futures contract traded on the exchange. Think of it as the physical foundation holding up a skyscraper of paper promises. On February 11th of this year, that foundation cracked in a way it has never cracked before. COMEX recorded a single-day negative adjustment of 3.26 million ounces. Total registered silver fell below 100 million ounces for the first time in years, in one day. Right now, that number sits around 82 million ounces. 4 months ago, it was 167 million. That is a 47% collapse in just 4 months. A drain running at 785,000 ounces per day, every single day, going one direction, out. And here is what that 82 million ounces is sitting against. The March 2026 futures contract alone represents between 425 and 528 million ounces of paper exposure. That is more than 5 times the available physical silver at COMEX. 5 people own the same ounce. And right now, all of them want delivery at the same time. These are not projections. These are the exact numbers sitting in CME Group's own warehouse reports right now as you watch this video. In January, which is historically one of the quietest months on COMEX, deliveries came in between 33 and 49 million ounces. The historical January average is 6 to 7 million. That is 7 times normal. In a month, that is not even supposed to matter. And February 27th is first notice day for March. That is the day holders of long positions must declare whether they want physical delivery or will roll their contract forward. March is the biggest delivery month of the year, and the inventory that is supposed to back it has already collapsed by nearly half, with the drain still accelerating. Now here is the detail that almost nobody is talking about. And this is where it gets really interesting. Buyers in January were not rolling their contracts forward to March the way normal markets work. They were rolling backward. They were selling March contracts and buying January contracts, paying premiums to move into an earlier delivery month that was already in active delivery. That does not happen in a market where people trust the future months will have metal. That only happens when sophisticated institutional money believes the March vault is going to come up short. They were not waiting. They were taking the metal now at any cost. JP Morgan was the institution doing most of the delivering. On a single day in January, JP Morgan issued 99% of all silver delivery warrants, 8.1 million ounces through 1,724 contracts, coming from one bank. Now here's where it gets infuriating, and I mean genuinely infuriating. JP Morgan paid $920 million in fines in 2020 for manipulating precious metals markets. Their head of precious metals trading went to federal prison. The word used in the conviction was racketeering. They placed fake orders to move prices. They admitted it. That same institution is now issuing 99% of silver delivery warrants, while March open interest sits at 500 million ounces against 82 million ounces of physical. Think about the game theory here for a moment. If you know that physical silver is disappearing from COMEX at 785,000 ounces per day, and you are an authorized participant in the paper market who can short futures contracts, you have every incentive to keep the paper price suppressed while you quietly accumulate physical at a discount. You short the paper market to cap the price. You take physical delivery at that suppressed price through the delivery mechanism. You accumulate real metal while retail investors watch the paper chart and think everything is normal. And when you have enough, you step back. You let the price find its real level. Silver hit 121.67 per ounce on January 29th of this year. Then it was smashed back to around $79 in what multiple analysts called the worst single-session silver decline since 1980. CME raised maintenance margins to $3,500, a 47% increase in one move. That margin hike clears out leveraged retail, forces liquidations, drives the price lower. The same institutions that were short then cover at or near the bottom. Reset, begin accumulation again. It is the same playbook they ran in 1980, the same playbook they ran in 2011. But here is what is different this time, and this is the part the bears have no answer for. In 1980, retail demand was the engine. Eliminate the Hunt brothers through Silver Rule 7 and the buying pressure collapses. In 2011, retail leverage was the driver. 5 margin hikes in 9 days flush out the speculators and the rally dies. In both cases, the demand was financial. You could destroy it by scaring away the buyers. But right now, the demand-draining COMEX is not speculative. It is structural. Solar panel manufacturing consumes 300 million ounces of silver every single year. Every panel built uses silver paste. There's no substitute that works at scale. Electric vehicle production uses silver in every charging contact, every circuit board, every power management system. And solid-state batteries, which BMW is partnering with Samsung to deploy in vehicles later this year, could require up to 1 kilogram of silver per battery pack. That is 40 times more than a standard lithium-ion battery. Stanford researchers published a study in January confirming that a 3-nanometer silver coating makes solid-state battery components 5 times more resistant to damage. One study, published this year, opening an entirely new category of silver demand. A margin hike on a COMEX futures contract does not stop a solar panel factory from needing silver paste. Industrial manufacturers are not speculators who can be scared away. They need the metal to build things the world uses. And now Samsung confirmed this themselves. Samsung signed a deal with a Canadian mining company to lock up 100% of that mine's silver output for 2 full years. Not buying on the open market, not hedging through futures, locking up the entire mine, directly, before the metal ever reaches an exchange. Think about the boardroom conversation that led to that decision. Some executives stood up and said, "We cannot rely on the market to supply our silver anymore. We need to go to the source before it is gone." When Samsung bypasses COMEX entirely and goes straight to a mine, the message is not subtle. They know something the paper price has not caught up to yet. And the Silver Institute is projecting a 6th consecutive year of structural supply deficit in 2026, 6th year in a row where the world consumes more silver than it mines. The estimated shortfall this year is between 67 and 200 million ounces, depending on the analysis. To put that in perspective, 67 million ounces is roughly equal to the entire annual output of Mexico, the world's largest silver-producing country. We need an entire extra Mexico's worth of silver just to meet demand this year, and that Mexico does not exist. Now let me bring in the third force, because this one lit a fire under everything else already in motion. This past Friday, the Supreme Court of the United States struck down Trump's tariffs. 6-3, gone. The court ruled that the president had exceeded his authority using the International Emergency Economic Powers Act to impose sweeping global tariffs. And within hours of that ruling coming down, Trump signed a new executive order implementing a 10% global tariff under a completely different law. By Saturday, he had raised it to 15%, the legal maximum under that statute. Effective immediately. Let that sequence sink in. His tariffs get struck down by the highest court in the land. His own appointees voted against him. And his response was to immediately implement new tariffs using a different law, escalating to the maximum within 24 hours. He did not negotiate. He did not de-escalate. He hit maximum immediately. Then on Monday, the European Parliament froze ratification of the Turnberry trade deal with the United States. The EU's Trade Committee chair, Bernd Lange, called it pure tariff chaos from the US administration. The lead EU trade negotiator said they had no other option but to delay. The deal was scheduled for a final vote on Tuesday. It got frozen instead. This is the second freeze of this deal in 2 months, the largest trade relationship on the planet. Frozen. Twice. And Trump's response to the freeze was a post on Truth Social warning that any country that wants to play games with the ridiculous Supreme Court decision will be met with a much higher tariff. And worse, all caps, buyer beware. That is not diplomacy, that is escalation, pure and raw. And every single escalation in this trade war has been bullish for gold and silver. Everyone. Because escalation means uncertainty. Uncertainty means risk. And when risk spikes, capital flows into the only assets that cannot be printed, cannot be legislated away, and cannot be struck down by any court. Gold is sitting above $5,000 per ounce right now. It's at a nominal all-time high of $5,195 in late January. Goldman Sachs has a $6,300 year-end target. Deutsche Bank has $6,000. JP Morgan's own research division published a projection of $6,000 plus. These are not fringe predictions from anonymous accounts. These are the largest financial institutions on the planet telling you openly where they see this going. And here's the fourth force, the one that ties everything together. The gold-silver ratio is compressing right now in real time. A few months ago, it was sitting near 65, meaning you needed 65 ounces of silver to buy 1 ounce of gold. Right now, that ratio has compressed toward 58 to 59. Silver is outperforming gold on a percentage basis. And when the ratio compresses like this, it means the market is waking up to something. It is waking up to the fact that silver is running out of places to come from. China locked the door on 60 to 70% of global exports. COMEX is draining at 785,000 ounces per day. Industrial demand is growing faster than mine output. Samsung is going directly to mines. And the Silver Institute just confirmed the 6th straight year of structural deficit. If gold hits $5,500 and the ratio compresses to 40, silver goes to $138. If it compresses to 35, silver is at $150. The historical ratio during full squeeze events has dropped to 15 and 20. I am not telling you those numbers happen this month, but the direction of compression is not in question, and it is accelerating. The resistance level that matters right now is $92. If silver breaks $92 and closes above it on volume, the path to $100 opens fast. There's very little technical resistance between $92 and $100 because silver moved through that zone so quickly in January that it never built a real base there. Watch $92. That is the confirmation. Now, let me be direct with you about the risk, because I always call both sides. If there is a sudden trade deal, if tariff tensions de-escalate overnight, if an Iran nuclear agreement gets signed, silver and gold could pull back 5 to 8% short term, and silver can move violently in both directions. We saw that in January when it dropped from $121 to $79 in days. But here is what the bears cannot explain. After every margin hike, after every manufactured sell-off, after every rule change, the drain at COMEX did not slow, the China restrictions did not reverse, the Samsung deal did not get canceled, the Silver Institute's 6th-year deficit did not disappear. The Band-Aid does not fix the wound. And every time they use a Band-Aid, trust in the paper market erodes a little further. Show me where the new silver supply is coming from. Show me the new mines. Show me the recycling capacity that fills a 67 to 200 million ounce annual gap. Show me the substitute technology that replaces silver in solar panels and EV systems and AI servers. Nobody can. Because it does not exist. New mines take 7 to 10 years to permit and build. And we have not built enough of them. We have not been building enough of them for 6 consecutive years. Here is where we are right now. Silver at $88. China's recyclers paying $96 for scrap. COMEX registered inventory at 82 million ounces and draining at 785,000 ounces per day. March open interest representing 500 million ounces of paper claims against that 82 million in physical. The Supreme Court knocked out Trump's tariffs. Trump immediately replaced them with 15% global tariffs at the legal maximum. The EU froze the largest trade deal on earth. Samsung locked up an entire mine. The Silver Institute confirmed the 6th consecutive year of supply deficit. Tell me when, in the last 50 years, you have seen all of these forces collide at the same time. I have looked. I cannot find it. The system is not breaking slowly. It is being drained in real time. China is keeping the metal. COMEX is losing the metal. Institutions are locking up the metal directly at the source, and the price has not caught up yet. That is the disconnect. And that is why $100 silver is not the story. What comes after is, if you are getting information here that your financial advisor is not showing you, subscribe and hit the bell. Because when this market moves, it moves fast. And this is not the kind of data that comes with a press release explaining why it matters. Now you have it. Do your own research. Verify every number I gave you from the primary sources, and then decide what you think comes next.